Thanks everyone for joining us for the CFA New Zealand Ethics webinar. So firstly, I'm Christina Leung, Vice Chair of the CFA New Zealand Society. And then for this webinar, firstly I'll introduce our speaker. Very delighted to introduce Dr. Harvey Nguyen, PhD, and also Senior Lecturer at the School of Economics and Finance at Massey University. Now, Harvey is the Director of Doctoral Studies and Deputy Director of Sustainability and CSR Research Group, and also serves on the editorial board of a number of journals. He's also published in internationally recognized journals and also has won several Best Paper Awards, one of which he's presenting today. So he'll be presenting on the research paper Insider Trading and Corporate Board Reforms, looking at international evidence. Now, this paper won the CFA Institute Asia Pacific Research Exchange Best Paper Award this year at the New Zealand Finance Colloquium. So congrats again, Harvey. And also, before we get underway, there's a Q&A function in Zoom for which I'll encourage you to ask questions, and then I can moderate those questions at the end. Thanks, Harvey.
Thanks a lot, Christina, for the great invitations and presentations, introductions. Thanks Kylie and Jeff for the opportunities to share my work. Thanks everyone for attending this webinar. It's my great pleasure to share my work with you guys. It is a joint work with my co-author Mia from the universities and Richards from Zhangji University in Taiwan. As you can see from the title, in this research, we focus on insider trading. So insider trading is one of the biggest threats to the integrities and efficiencies of financial markets. And insider trading has attracted increasing attention from both academics and practitioners. And there's intensive literature considering various impacts of insider trading on corporations, on investors, and other capital market participations. So in our humble research, we take a step. We ask for the driving force of insider trading, and more importantly, the potential mechanisms that can mitigate insider transactions. So let me start with the background of our study. So why insider trading? It is, basically refers to the misuse of materials, non-public information for personal purpose. And insider trading involve trading in public, company securities using non-public material information about the firm. And there's a lot of details about how to quantify as material information. And the essentials of the rules is that the information, would move the stock price in either directions, count as material, and this information must not be generally available to the public. So these two criteria are quantified as material information. And insider trading and sharing of the sensitive financial information is big no, right? A big no in New Zealand. Insider trading laws in New Zealand view overall the concepts of information insider. Right? And the definitions of information insider is relatively broad. So the law in New Zealand defines an information insider as any persons in possession of material information about public firms and other body that issues financial products. And New Zealand in particular have a strong stringent laws and regulations to prevent certain information, from being shared. Since 2011, the Financial Market Authorities (FMA) has been responsible for enforcing these rules, which prohibit information insider from disclosing information when they know, right? And with the offenders facing up to 5 years in prisons or a fine of up to $1 million, or 3 times the gains matched by the transactions. So the regulations has been effective so far. And for our studies, why we focus on insider trading because insider trading matters. And the prominent criticisms voiced against insider transactions argue that, right, insider trading may exacerbate the agency problem. It may harm the investor attentions. It may increase the transaction costs. On the other hand, the supporter of legal insider trading argue that insider trading can have improved the efficiencies of financial markets and a way for firms to compensate their managers for their performance. So there's distinctions between legal insider trading and illegal insider trading. And the main difference based on whether this information is non-public and materials or not, and whether the insider they disclose their debt following the rules. So the majorities of research on insider trading so far focus on legal insider trading, where we have access to the data. There are some papers and some working papers on illegal insider trading where they manually check for these transactions. These transactions are not publicly available, so the information needs to be manually collected from different sources. So insider trading is more prevalent than our talks. In an article in New York Times reviews that a study that looked at hundreds of deals involving companies from 1996 to 2012 in the US. They found that 1 in 4 transactions were surrounded by some kind of insider trading, insider transactions, and despite significant amounts of effort to mitigate insider trading, significant insider transactions continue to make headlines. Here we collect the numbers of media mentions on insider trading from Factible's Global Daily News. So Factible's Global News database report, right? The numbers of media mentions on insider trading. That is from 1980s to 2018. And as you can see, right, over the period from 2000 to 2018 on average, insider trading is mentioned in the media more than 300 times more frequently than in 1980. So you can see, right, a lot of attention, has been, dedicated to insider trading, and it's evident by increasing numbers of media mentions over time. So we ask a simple yet meaningful questions. Do government practice mitigate insider trading around the world? So as you can see from our research questions, right, we look at insider trading cross country. And for motivations for this particular, research, right, whether corporate governance or government practice, right, mitigate insider trading, right, our motivation is, supported by several limitations and gaps in the literatures. The major limitations, right, in the prior research lies in the endogenous natures of both governance structures and insider tradings, which casts down about the casual or the causality relations, and the large variations in the information environment and corporate governance practice across the world. And there are significant variations in the information environment in international setting. So our main research question, right, the effects of government practice on insider trading across the globe is important, yet not fully investigated research questions. So this open the room for study. And how we address the potential endogenities and how we can, proceed with the causal, impact of the potential relations. So in our setting, we examine how the wave of the worldwide corporate board reforms affect insider trading activities. And there are 2 important benefits from the quasi and nature experience. First, Major board reforms provide variations in government practice that are exogenous to the firm's internal policies, and it allows us to establish the causal inference between governance and insider trading, if there is. The second benefit, right? Country-level board reform captures shocks to board governments for the universal set of firms in 41 countries, and it allows, right? It provides greater variations in governance than any single countries. So why the connections between governance and insider trading had attracted attentions from both academic and practitioner for several decades. It merely focused on a single country's setting, and the main issues, the main limitations in the prior study is the endogeneity issues. And in our paper, right, we employ the wave of the worldwide corporate board reforms as exogenous shocks. So here comes our prediction. So what exactly, right, the board reform? What is the information contents of the board reforms, and how it relates to insider transaction? There are several predictions from the theoretical point of view, right, from the literature. They provide mixed predictions on potential relations between, board reform, the adoption of board reform around the world, and insider transactions. So in the first predictions, right, which we call the monitoring hypothesis, right, if the focus of the board reform on improving the board oversight, the board functions, or fiduciary duties, which will restrict the corporate insider from extracts the profit benefit, right? For example, exploring the profit information when trading, and these predictions get the negative relations between the adoption of both reforms and insider transactions. Now, on the other hand, the second predictions, right, which we call the substitutions hypothesis, the board reforms make it harder for the insider to reap their profit benefit. And the insider, therefore, might consider or have to rely on other benefits. For example, the profit from insider trading. So under the second predictions, right, there it suggests the positive relations between board reform and insider trading. And last but not least, right, these two variables may be irrelevant, which is we call irrelevant hypothesis. Right, the firm with strong governance itself may not experience the significant change in governance following the board reforms, and the firm might strictly avoid the directors who appear to be independent but effectively have personal relation with the firm, which suggests that there's no relations between the adoptions of the board reform and insider transactions. Now, at the moment of truth, right, when we come to the data, we see how actually this relation work. Now, in order to conduct studies, especially empirical study, we have to rely on data sets. And here we employ the global insider transactions from 2IKs, from 2IQ, global insider trading database. It contains over 10 million insider transactions across countries and provides the most complete event in insider transactions historical for all insider. So this is the snapshot, the coverage of the data from 2IQ insider trading database. As you can see, right on the left hand side, we have the numbers of unique firms and companies that the database input. And as you can see, right, the numbers of unique firms vary across regions, from Europe, Asia, North America. I hear some questions, so can you repeat your questions?
I think maybe it's someone that didn't have their microphone muted. So if everyone could mute their microphones during this, thank you.
Oh, thanks a lot. I thought it's a question. So any questions, feel free to let me know, or you can wait until the Q&A sections. Yeah, I'm fine with either way. So this is the regional coverage of the 2IQ database that we have. As you see, right, it has quite a few numbers of firms, unique firms across countries. Now, this is the snapshot of the data. So this is I provide a snapshot of the data. So as you can see, we can have access to every single insider transactions. As you can see, we have the transaction IDs, we have the company names, we have the name of the insider, and we know exactly whether it is a buy or sell transactions. We know the number of shares that the insider transacts. We know the transaction dates. We know the price. We know the volumes. We know the trading volumes, and we know the traded shares. So based on our comprehensive data, we know and we can have access to the complete individual transactions across countries. So here, 41 countries, is around more than 23 case, 23,000 unique firms in our samples. As I mentioned earlier, right, due to the data availabilities, we focus on legal insider trading. Legal insider trading, right? The difference, as I mentioned, between legal and illegal insider trading is where the information that is used for the trading is non-public material information, and whether the insider disclose their trade following the rules or not. So here we focus on legal insider trading. The insider trading is where we can have access to their report. In our future study, right, we consider illegal insider trading, which requires a lot more work in terms of collecting, because for illegal insider trading, not all of the transactions are recorded. So it takes a while to actually check back the transactions, and that's why in our current study we focus on the data when we have access. So here, from 2IQ insider, the global insider trading data, we have access to every single legal insider transactions. We have details in terms of the transaction types, in terms of the share, the volume, in terms of the individual insider, the company, so on and so forth. So, and here comes our example. Right, we obtain the firm level financial data from our source, the Compostat globally, Compostat North Americas, stock return information from the Capital IQ database. Our sample, right, consists of about 120K value observations, covering unique about 23,000 firms, unique firms in 41 countries from 2000 to the end of 2019. So that is the largest sample at the time of writings from our portal. And so our main variety of interest is insider trading measures. So how we measure insider tradings, right? We start with a couple of screening procedure, right, to clean the data, to make sure that the data that we are using for analysis is clear and not contain any noise. So for insider trading measure, we consider three unique measures. The first one is number of objects. Second one is trading volume, and the third one is traded value. So it provides, right, the comprehensive measure of insider trading in terms of both quantity and quality, right? Number of objects, trading volume, and traded value for each transactions. And this provide a snapshot of the observations in the countries in our sample, right? We know the board reform keys for each country, and that allows us to conduct a study, right? We look at 3 years before and 3 years after the event years and see the difference. And we have also the number of firm years and frequencies of each country's firms in our full sample. And I think it's worth mentioning here, we do not have New Zealand in our sample for 41 countries because of two reasons. First, insider transactions recorded in New Zealand are not quite large. We just have a few observations with that, and we do not have information with regards to the board reform information in New Zealand. So 41 countries covered in the study, there's no information for New Zealand. That's why New Zealand is not in our sample. But we have Australia, we have Belgium, we have Brazil, we have countries in developing and developed markets. And in the next few slides, you will see I also look at how the country characteristics also look at the frequencies and the magnitudes and insider trading following the board reform. So here comes our identification strategies, right? And we employ an enjoyment shocks that varies by time and locations for identifications to make the causal inference. So basically, we want to invest the impacts of the board reforms on insider tradings using the different DID estimation. So to put it in the simple term, our main variable of interest is B1, as you can see is the one highlighted in red. B1 that captures the average effects of board reform for treatment groups and relative to control group. And we use the standard econometric techniques to make sure that we control for objects variables in the model. So B1 is our variable in interest, and it captures the effects of board reform on insider tradings. And here comes our main results. As you can see, we look at three measures in insider trading: the number of insider transactions, trading volume, and traded value. So pause here is an indicator equal 1 starting the year in which the board reform become effective in the countries, and 0 otherwise. We also look at different ways to define dummy variables. Support trees, a dummy pause tree, for example, is a dummy variable that equal 1 beginnings in the year when major reform become effective in countries that pass 3 reforms component. So there are 3 reform components. The first one is independent board. The second one is the audit committee's independent, and the third one is the CEO and chair's reform. So pause 2 and pause 1 basically an indicator, that equal 1 beginning in the year when the reform become effective in countries that pass at least 1 or at least 2 of the reform component. So basically, we found that these are quite robust. So the main conclusion or the main finding of this result of this table is following the adoptions of the board reforms, we see the significant reductions in number of insider trading, which basically consistent with our monitoring hypothesis. And we employ other, standard, economic tactics to make sure that our results are robust. So we consider the first different model to address the unobserved heterogeneities in the panel data. And as you can see, the negative and significant results suggest that the magnitudes and frequencies of insider trading actually reduced following the adoptions of the board reform in each countries. We consider the standard propensity score matchings. Basically, the idea is the PSM propensity score matching is to generate a match sample of treatment and control groups by zeroing the board reform. We found the match sample, consistent with a baseline result, And we also look at the entropy balancing weighted as an alternative way for PSM propensity score matchings. Now we are interested in the mechanisms or the channels through which that the adoptions of the board reform can affect insider trading. So we further investigate the possible mechanism through which the board reforms affect insider trading, and Right. So what exactly, right? How board reform affect insider trading? And the prior study suggests that the board reforms may reduce the stock market cross rate by improving the information transparency. So we consider where decreased information asymmetries have curved insider tradings after the board reform. So these are predictions, and we have to test for that. And to test for this possibility, we examine the effects of board reform on insider tradings conditions on the pre-reform corporate information environment. So we conjecture that firms with high level of information asymmetry should benefit more from the reductions in information asymmetries as induced by the board reform. And as a result, we result in a larger reduction in insider trading following the reform. And we to quantify for information asymmetry, we follow the literature and use three different measures. We use the Bidena spread, we use the information opacity, we use the Porter spread as three measures for information asymmetry. And as you can see here, the result are consistent with our predictions that the decreased information asymmetries have curved the insider transactions after the adoptions of sport reform across country. Then we look at whether the institutional features matter in this particular relations. So we focus on the moderating effects of the country level characteristic. Right here, we look at countries with the variations in the anti-director index, with the effective judicial series, public enforcement, and legal origins. So we found the effects of both reforms on firm level insider tradings are more pronounced in countries with more rigorous legal system. For example, countries with high public enforcements, with more investor protections, and a potential explanation for this result is the rigorous legal system would better enhance the effectiveness of the reform, right? And the relations between board reform and insider tradings is more pronounced in common law countries, and possibly, corporate governance mechanisms in common law countries would make it easier for the firms in these countries to implement the change in the board reform, leading to more significant declines in insider transactions for the reform. So country characteristic matter, right? Institutional characteristic matter. We also look at countries with different corruption perceptions, the financial reporting qualities or disclosure requirement, and we see that the impacts of the adoption of board reform on insider transactions do varies across country, depends on the country's information environment. And so far we talked about insider tradings with regards to the magnitudes and the frequencies of insider tradings, the number of trades, the trading volume, traded value. How about trading profits, which is one of the important criteria that many people keen on, investors keen on, the trading profit, whether they actually make profits from a particular insider tradings. In our reported result, the answer is yes. We do observe the abnormal trading profit, the abnormal trading alpha, suggesting that the insider they do make profits from insider tradings. But more importantly, when we comes to the board reform and the impacts of board reform on insider tradings, we found that the board reform actually reduced. Following the board reforms, the insider trading profit actually declines, which is pretty good and consistent with the previous result. So not only the magnitude and the frequency of insider tradings, but also the profit from insider trading declines after the board reform. And as you recall from our starting point, the board reform here is basically an exogenous shock to corporate government. So it basically suggests that government practice, right, really matter in mitigating insider trading in both magnitude, frequencies, and the profit from insider trading. In order to measure insider trading profit, we look at the stock returns from three factor models over 6 months following the transaction. So for every single transactions, we look at the stock returns performance 6 months following the transactions to capture the profit. And because we have access to every single transaction data, it allows us to compute the insider trading profit for every single transactions. So thanks to the data, and it's allowed to conduct a comprehensive evidence. And as I mentioned earlier, we did a working paper. We worked on these projects over the last 3 years, and there's quite a few additional analysis we performed. For example, we conduct several tests to validate the parallel chain assumptions, which is fundamental for the dynamic difference model. We consider the graphical analysis, the place test of the dynamic DID, which I will show you in just a minute. We consider different models on the model estimations, different fixed effects, right? Different clustering to make sure that these stuff are not affect our result, our robot are not affected by any specific model. We consider different components and implementations approach of the reform, whether reform is rule-based or complies or explain. And we also look at three components of the board reforms: the board independence, the audit committee's independence, and the CEO and chair reforms result are quite similar to the result that I present so far. We looked at alternative sample to see make sure that our sample are not driven by any outliers. We exclude firms from the US, Canada, China, which account for about 65% of the entire sample, right? And our result remain robust, right? We conduct the other alternative sample. We also consider the country level insider trading. So far, we look at every single insider trading, and when we aggregate them into the firm level, so we know exactly for each firm how many insider transactions has been taken in a given year. Now we move to a more conservative step. We consider the country level difference analysis, which lead to a small sample. Right, we lose the variations within each country, but this conservative analysis can provide a simple interpretations of our main result, right? Because our result, right, based on the adoption of board reform, basically suggests that following the board reforms, right, following the improvements in government practice, the insider trading, the transactions declines in terms of both quantity, of the magnitudes and the profit. So using the country level insider tradings provide a simple interpretations of our findings. And we also look at litigation risks, right? Because insider tradings may be associated with litigation risks, and we found that high litigation risks need to use insider trading. So here comes a couple of our additional results when we look at the dynamic effects of board reform. Here we consider 2 years before and 2 years after the adoptions of the board reform. So using each board reform for each country as an event, look at 2 years before, 2 years after the event, and see the difference. We have a couple of time indicators. Year T-1 basically equal 1 if it's 1 year before the reform, right? Year 0, which it is the adoption year, and year 1 plus, which is the indicator equal 1 for 1 year after the adoption years. So we found that using the dynamic board reform, you see that the impact of board reforms on insider transactions only effective, following the reform, not before, which is provide support for our value chain tests. Here comes our country level insider trading, right? A simple story from our analysis. As you see, the number of observations drops significantly. Here we look at country year observations, and we still found our results suggest that insider trading declines after the adoption of both reform. So long story short, so what is the key takeaways from our paper? So we found that insider trading activities and the trading profitability significantly drop after the board reforms. And the effects of board reforms on insider trading are more pronounced for the compulsory rather than voluntary reform. And in terms of mechanisms, we found that following the adoption of board reform, information environments improve, and then it led to the reductions in insider trading. And we also look at the institutional features, and we found that the effects of reform on insider trading varies across the institutional feature. So basically, we respond to the mock and other prior study who call for the research that enrich our understandings of the determinants and the magnitudes of insider trading across the world with different institutional settings. And our research also provides some implication for industry, where we actually can provide a causal relations between government practice, right, and insider trading. That and by utilizing the wake up board reform that provide exogenous shocks to the corporate government practice that allows us to derive this causal relation. So this is the end of my studies. Any comments and feedback is welcome. So I think we can open the Q&A sections.
That's great. Thanks so much, Harvey. So we do have a few questions. I'll start off with what's in the Q&A. How do we measure the cost of insider trading from a statistical perspective on the cost of capital for firms?
That's an excellent question. So in terms of the average, how we quantify, so here in our particular study, we do not have that measures. And from the literature, from my point of view, and from what I learned from the literature so far, there's no direct measures of the cost of insider trading to the firm, because insider trading they have various impacts on both the corporations, the investor, and other firm stakeholders. So in order to derive the direct measures of insider trading or insider transactions on the firm's perspective or the firm outcome is not an easy measure, because it can include both direct and indirect costs. So reputation costs, how can we measure reputation costs? Probably there's no perfect measure for reputation costs. The litigation costs as well, because insider trading may involve or may be associated with litigation risks. So how we capture litigation risks. So there are both direct and indirect costs that associated with insider trading that cannot be measured using a single metrics. So if we put into a different angle, if we just focus on the firm, stock price or stock performance, then we can look at the stock price or the stock performance of the firm following the insider transactions. So that is what we will look at, say, for example, the profit, right? Insider trading profit, whether after the transactions, we look at their stock returns following the transactions, 6 months following the transaction, and see the difference. So if we look at these questions from different angle, if we focus on the stock return only, then it is doable, because we can look at the stock return, the stock returns of the particular firm following the transactions to estimate the cost. But in order to derive a comprehensive measures of the cost of insider trading to the firm, is not an easy task, because it involves both direct and indirect costs, which cannot be measured using a single metrics. So I hope that my answer, answered your questions. But I'm open to any further discussions.
The next question is, which governance reforms have the largest impact on insider trading volumes?
From the here we come. So let me look at so we have three components of insider tradings. We have three components of the board reforms, and from our results, that the board independence have the largest impacts on insider transactions. So we have board reforms. We have three components of the board reform: the board independence, the audit committee's independence, and the CEO chair's reform. So among these three components, board independence have the largest impacts on insider transactions. Thank you for the questions. That's excellent questions.
And the next question is, do your outcomes change if you extend your insider profit measurement period from 6 months to 12 months or longer?
That's an excellent questions as well. So the result is no. Our results are robust, whether we use 6 months or 12 months following the transaction date. The reason that we use 6 months or 100 or 180 days following the transactions, it is because of the rules from the authorities in the US, the SEC, right, require that. So following the rules from the SECs, from the regulations that the insider have to report that insider trading during a given time frame. And because if we look at the longer period, say 1, 2, 3 years, and then we may have other events that overlap with the event years. So the current literatures and the current empirical normally look at 6 months following the insider tradings, but our results are robust if we look at 6 months or 12 months following the insider tradings. We are not able to look at 2 years, 3 years, or 4 years following the insider tradings because we cannot account for the other events that may occur, right? Many events, macro events, and occur. Election, for example, if we look at, let's say, 4 years following the particle insider transactions, then other effects, other events may affect the results, and we cannot distinguish the impacts from the board reform and other macro events. So 6 months or maximum 10 months or maximum 12 months following the transaction date is normally the period when we consider to measure insider trading profit. And also remember that the market is quite efficient. Investors are very smart, right? So yeah, we cannot, if the for efficient market, right? If the market efficient, the stock price should the information should be included into the stock price, easily. So 6 months or 12 months following the transaction should be the reasonable time frame to look at, not shorter or not longer. That's from my point of view. And thanks very much for the questions.
Great. Those are all the questions we had. Thanks so much for your presentation. That was very informative and good to know that there is an impact of these reforms.
Yeah, we really keen on this piece of research because I think it has some practical implications. So normally when we talk about governance or governance practice, right, we talk about from the general or the broad view. The governance, the definition of governance is relatively broad. But if we put in the general terms, it refers to assess rules and the norms that the firm managers that use to run their firm, and it includes the norms and also the respect that the employee within the firm respect. So how these set of values and rules and can mitigate insider transactions, a part of the market's threats is really important, but have been not fully studied or investigated so far. So it motivates us to conduct a comprehensive study when we look at across country settings and see whether the governance, right, the COVID governance across countries actually play roles in mitigating the insider transactions, and hope that this research will you guys may think that this research will be valuable, and from the corporation point of view, they may find that something that can be applied or adopted in their organizations to make sure that to reduce the potential wrongdoing and to make sure the integrity and efficiencies of the markets.
Yep, definitely. Thank you, Harvey, and thanks everyone for attending this webinar, the recording of which can be available later on.
Yeah, thanks everyone for attending this webinar. Thank you and enjoy the rest of the day. Thanks and bye for now. Thank you.
Thank you. Thanks.
Thank you. Thanks, Christina. Thanks, Harvey. Bye.
Thanks.